Oh, hi and welcome. My name is Casey Boland. I'm a wealth advisor with HCM Wealth Advisors. Thank you for joining us today on this short video. I'm joined today by Doug Johnson, who's our Senior Investment Strategist, and Dan Rinck, who's a Research Analyst with HCM Wealth Advisors. We wanted to keep you apprised. Last week on Friday, we sent out a video with Dan and Doug, given what's going on with the circumstances, the market reaction with a hard sell-off on Thursday and Friday in response to the proposed tariffs by President Trump. Part of the news last week on Friday, the guys talked about China lashed back with retaliatory tariffs, which weighed on the market on Friday as well. So coming into Monday, we were looking, saying, are we going to get a rebound in the market? What's going to happen? And you see, we had a very volatile Monday. The selling continued out the gate. The Dow was down over 1,700 points. And then actually later during the morning, quickly moved up to being up 800 to 900 points. So you had almost a 7% swing in a very short period of time. There was a rumor that came out that maybe these tariffs are going to be delayed for 90 days, which turned out not to be true. So the reason we even mentioned yesterday, we even hate to talk about one-day moves in the markets, is just that if we do get a whiff of potentially some news that might bring some short-term resolution to what we're dealing with right now, it really shows how much of a move that you can have in the market in such a rebound. Because right now, I think the feeling can be, I want to try to move to the sidelines and avoid this mess. But the reality is, in the short term, if we have some resolutions, the market can swing back very quickly. And there's just a lot of unknowns. So today, we're recording this on Tuesday. The market is up now over 1,200 points. It's up over 3%, but the day is young. The day is young. So how might this play out over the course of time? So we're looking at a couple days, but the reality is these things take time to play out. But the key is the longer it takes, the more potential damage that we could be dealing with from the economy and certainly to earnings, which means that really could negatively impact the market. So if we have a short-term resolution, so what you're looking at is a chart related to uncertainty. And if this is a short period of time, maybe within a few quarters, then we may be able to get back on a upward trajectory, and it's a temporary shock, and we can rebound from that. Doesn't mean there's not damage, but something that can be resolved. But the longer this goes, then the more deeper the damage that can be done to the economy. And so at this point in time, we're still early in this game. And I think trying to make decisions based upon the depths of where this market could go, it's just too early to tell. A lot can be done in a short period of time. But certainly, the longer the period that this is in motion, we certainly have the understanding that this could really do some serious economic damage. So from a historical standpoint, when you look at history, there have been, let's see, 39, 43, 46 10% corrections. Not all of them result in bear markets. So you can see 32 of them resulted in corrections in the neighborhood of 10 to 20%. Yesterday, intraday, we hit down 20% for the S&P. Most people, when they look at this data, don't count that into the camp that we've kind of fallen into bear market, that camp yet. But when you look at history, you have another 14 that fall into the camp of being in a bear market, and they can range from anywhere from 20 to 30 to 30 to 40. And then there's those couple occasions where things are down 40% or more. The average, it falls more in the camp of the 34 to 35% camp when you have the recession that's tied to a bear market. Now, obviously, that doesn't tell us a lot about where we are today and where we're headed. So that's where we're going to dig into a little bit more of the details. But one quick point, guys, I think before I kind of hand it off here, the challenge of history is that every past decline always looks like an opportunity, and every future decline looks like a risk. This is the challenge to investors. This is a challenge to organizations like ours. But we have a process that we follow. And so we're going to talk about that a bit more. We had some good feedback from people asking a little bit more about, hey, what are some of the indicators that you look at, review? So, guys, where do we stand with some of the recent data? What might this mean to earnings, economic revisions? I know I asked some loaded questions there, Doug.
Well, I think, and I'm stealing this from somebody else. I think it's okay right now to say, I don't know. Um, you've got a tremendous amount of uncertainty. These timelines are changing quickly. So, I was joking with somebody the other day, maybe my wife. I'm tired of dealing with unprecedented markets. And I mean, in a lot of ways, it feels like we're back in one of those times. I mean, I remember going through COVID, and now some of the moves that we've seen here. This feels unprecedented in the way it's playing out. You on average see a bear market, and we hit a bear market intraday yesterday, so I'm going to count it. Um, we've had 4 bear markets in the last 8 years, right?
Wow.
So that's both under a Republican president and a Democratic president, so it's not a political thing. But the average bear market is once every 4 years. So we've had a lot of unique markets and things happening over the past decade. I'm ready for it to be over. But at any rate, we're smack dab in the middle of it right now. So Dan, can you kind of give us an update on kind of where the market lies as of the close yesterday?
Yeah, absolutely. So there's some more work to be done for it to be over, Doug. I'm sorry. Um, so I want to just take a pulse on where the market is right now, what kind of key levels we're looking at, and maybe we can use that to inform our decision on what's going on going forward. So in this chart, this is the NASDAQ 100 futures. This chart almost looks identical with the Dow and the S&P 500 in relation to these levels that I'm going to be looking at. So I chose the NASDAQ just because it has a lot of the um, more tech names that we're familiar with that have been in the headlines lately. So I wanted to take a look and kind of break down what has happened so far and where we're at currently. So the NASDAQ 100 futures, they are actually in a bear market. I don't count an intraday. I need to close, but we have fallen down into a very significant range. The range we're looking at is the end of the 2021 highs. So 2021 highs coming out of COVID, there was the big long stretch of strong outperformance in tech stocks and the S&P 500 and the Dow. That is an extremely key level. There's a lot of volume there. There's a lot of demand at that level. Through 2022, we broke down from that level, and then when we rallied up to get back through it, that there took a lot of volume to break through that level because it was a very significant level. So there was a lot of volume between the 2021 high and the 2024 when we broke out of it. So if you are looking at key levels, this one is extremely important. There's a lot of trading volume, there's a lot of buys there, a lot of people protecting positions at that point. Um, we are getting a bounce right now, a pretty significant bounce, which if you are stripping all the headlines out of it and just looking at the supply and demand of the market, you'd say this is exactly where it should bounce. Going forward, we really want to stay above this level. If we, bounce off this level, that'd be fantastic. That's kind of what is expected. If we continue hitting that level and then breaking down, then you have to assume that the current kind of bull market, secular bull market structure is in trouble. So right now we're looking at the market. It's bouncing pretty significantly today. Nasdaq's up almost 4.5 at this point. We're at 10 o'clock on Tuesday morning.
It's early.
It's rally. So you really need that level to hold. That's a major level there, kind of a line in the sand. And it's so far the market is doing exactly what is expected. Now, as far as our process, our risk reduction, our risk increases, Doug's going to talk a little bit more about that. What are we looking at there, Doug?
Well, so I'm going to show a few indicators that we pay attention to, but I want to reiterate, these are not the only things that we look at.
Hmm.
And I think the best way to try to understand this from a conceptual standpoint, it's almost like a medical diagnosis. So if you're having symptoms, you go to the doctor, and if those symptoms are mild, the doctor may just give you some medicine and send you home. If the symptoms get worse, they're going to run more tests and more tests to eventually find out what the condition may be. And it may be something that they couldn't figure out without these tests. And as your condition may worsen, the treatment for your condition will change. So I'd like to think of this as we have the market hooked up to monitors and tests at all times. And there's a lot of things that we can see behind the scenes from these that may tell us something that is not quite evident by just looking at the price action. There is a lot of, I would say, correlation between some of these things. But when we think about adjusting risk and even adding risk, well, I think adjusting or lowering risk mainly, in this case, it's we want to see things on these tests that give us concern. And once we are seeing those things, we will begin the process to slowly start to find ways to reduce risks in portfolios. So let me touch on two kind of risk off things that we will pay attention to. And again, let me reiterate, these are not the only things that we look at. These are just a few things because I want to give everyone a kind of an idea of how we look at this. So the first indicator that we're going to look at is called a MACD. It's a moving average convergence divergence. That's a tongue twister, all right? So without getting into the weeds on some of this stuff, this basically measures three time frames against one another for the S&P 500. All right, it's a momentum indicator, and what it's designed to do is tell us when the momentum in the market has shifted and or broken down in a significant way. Now, the beauty of this is you can set this to any time frame you want. You can set it to a very short time frame if you want to be a trader. We tend to set this longer term. We actually have two separate sets of times that we look at because trends that break down on longer terms, they're harder to break, right? They've been intact longer. Okay, so when we're looking at something like a MACD, we're simply looking for this signal to break down below zero. All right, and this chart here, there's a lot of lines on it. I understand that. This goes back 5 years, and I wanted to do the 5-year chart because it gives a very good example of exactly what we were looking at in 2022 and what we did in tactical portfolios. So right here, you can see this black line crossing below this red line, signifying that the market structure and momentum have changed significantly and broken down. All right, take that vertical line down and you're right around the top of the 2022 market. All right, so pretty good response there. Now we fast forward, same breakdown. This one's actually a little bit more aggressive, which makes sense considering that we've gone down almost 20% in the course of just a few weeks. But again, you move this down and you're getting a corresponding level with something that's close to what we can assume for now is a top. If we look back to October of 2023, this is an area where we actually implemented our equity overweight in tactical portfolios. You can see here, there was a compression, but it did not break. So market weakness is not always going to equal this triggering. All right, you need a significant break in the market momentum, and that tells us, okay, here is a risk popping up that the returns going forward are going to be to the downside. One other thing that you're probably hearing a lot of right now that nobody ever talks about is credit spreads. So credit spreads are essentially the difference between a treasury bond at a given maturity level, so 1, 3, 5, 10 year, whichever you want to pick, and a corresponding high yield bond. All right. So right now, when I transposed this, the line got stuck here. So this, you're actually seeing the reading from August 30th of 2005. So that's not the updated number. But you can see this very small spike that we've had up over the past few weeks. And I want to compare that to kind of some other, more, or say larger bear markets. So back in 2008, the great financial crisis, you had credit spreads get up to 2,000 basis points or 20%. So basically what that means is if you were buying a 5-year treasury bond and it was yielding 3% at that time, you could buy a high yield bond with a 5-year maturity and it would yield 23%. Right? This is the widest this has ever been. But you can see in other instances of market stress, these credit spreads will spike up. And this is concerning when we get past a certain level. Usually that's the 650 to 700 basis point or 6.5 or 7% level, because it's telling us that the kind of plumbing in the economy is starting to get stopped up a little bit. And when you get into a market that has a recession attached to it, usually you're getting something that's metastasizing into the economy. And those are the markets that can have the largest level of drawdowns. So when we see these start to spike up, it definitely gives us notice to say, okay, are we getting conditions in the economy now that are significantly worse to where you are bringing recession risks in and therefore bringing in a lower clearing level for the market? So these have moved up. They're sitting at right around 450 basis points right now, which again is still below the 25-year average of 500. Our triggers are a little bit higher than this, but to see a spike like this certainly has our attention. Now, all is not lost here. You do get to a point in markets where you get what we would call a washout. And basically a washout is an exhaustion in selling pressure. And when you get to these points, historically, the future return potential is greater than the future risk potential. So it may not be over the next week, over the next month, but 6, 12, 18 months out, your probability of getting strong returns is much higher than average. Okay. And we do reach points during these sell-offs where you can get these kind of washout levels. And therefore, we want to look at that situation and say, hey, maybe we're not selling anymore. Maybe we are now becoming buyers. And most of the time this happens when nobody wants to buy. Everybody's finding a reason not to do it. So in full and fair disclosure, to try to be balanced here, I want to show you 2 risk on indicators that we pay attention to. So one of these is the percentage of stocks trading above their 50-day moving average in the S&P 500. All right. So this goes back to 2000. We are currently trading at 7%. All right. So that means 7% of the S&P 500 stocks are trading above their 50-day moving average. If the trading holds today, that number will obviously increase. But you can get to levels that we would call washouts. So if you can take a look at this, this line graph down here, you notice some of the points that we've seen that have corresponded with, at least on the 50, levels that are 5% or below. That's kind of what we pay attention to. So here, denoted very closely to the bottom of the tech rack, we'll call it. Again, here, you're getting down low into the great financial crisis. Here you have the European debt crisis. Here you have the COVID bottom. Here you have the bottoming or close to the bottoming in the market in 2022. So these are not always going to give you a perfect signal, but they're going to give you an idea that the selling is almost over and it may start to become time to add risk. Now, we also pay attention to this on a 200-day moving average. Again, longer time frame, a little bit harder to get these numbers lower. So the threshold's slightly higher. But again, you can look at these kind of mountain charts, and this goes back to 1974. Again, below 10 corresponded to a bottom. Below 10 corresponded to a bottom. Below 10 corresponded to a bottom. So you can see there's very much a pattern here. And right now, for that number, we're trading at about 18.7. That'll go up after today. But when we think about adding risk back or getting to the point where it's time to not be sellers anymore, these are two of the components that we pay attention to, because they're going to give us indications that the selling has become exhausted in the short term. And we almost reached that point, I think, as we were sitting in our investment committee meeting on Monday morning, kind of watching these update in real time. We got extremely close with a few of these. But I like to say close is not enough. So let's finish with some perspective here. And I think it kind of relates to some of the topics that we just saw. But you just went through a top 10 two-day decline in the S&P 500. All right. So we were down 10.5% over the two-day period, I believe April 4th and 5th, or April 3rd and 4th. So look at some of these other dates and notice when they had happened. You have two in 1987, which was during Black Monday. And then you had one during COVID, and then everything, or you had two during COVID, excuse me. Then everything else is in 08. All right. So big moves over two-day periods. But look at the forward returns for the S&P 500 from these instances on a 1, 3, and 5 year time frame. They are exceptionally good. All right. Now, there's no rule that says this one has to be the same way. But when we look at things from a historical perspective and try to realize that we can reach points where the odds shift in your favor over the long term, that's when we want to try to not be emotional and scared, so to speak, and look at ways where we can start building long-term wealth again by adding risk back into portfolios. So again, this is a unique situation. It's one which could probably get resolved with a headline. It could probably get worse with a headline. We haven't seen a change in trade policy like this in close to a century. So, we're going to continue to monitor, everything that we have internally to determine what next steps may be. And we're getting a lot of questions, not only from clients, but even our advisors saying, hey, what's our next move? What's our next move? We don't necessarily know exactly what that is. We have scenarios planned out, and if certain things come to fruition, then we will act. But we're doing our best to take the emotions out of this and try to act as objectively as possible. So, guys, do you have anything to add on top of that?
I guess I would say lastly is keep in mind if you are in retirement, and we talk about this all the time. So I know sometimes you may get tired of hearing it, but it's important. And that is, as you can see, we have a plan to deal with these time periods, even though they can be quite challenging. But as it relates to someone in retirement who requires cash flow, we do have reserves in place. We have a bond ladder. We have a safety net that's there for these times to provide the interest, the dividends are being generated, as well as having safe and secure money that we can draw from to provide you cash flow during downturns in the market. So we are not forced sellers to having to realize losses to fund your capital needs. So that safety net's there. It's an essential element for your long-term plan and for clients' long-term success. So if there's questions that you have, don't hesitate to reach out to us. We appreciate this is a challenging time, and we'll continue to provide insight and thoughts and updates on a regular basis here. So thank you, everyone, and goodbye for now.